Welcome back to Talk Tickers, the show where we strip mine earnings calls for alpha so you don't have to listen to the hold music.
And today we have a big one.
Oh, a huge one. We're looking at a solar giant that just woke up and chose absolute violence against the short sellers. We're talking about Enphase Energy.
It was certainly a wake-up call. I don't think anyone really expected the magnitude of the reaction we saw.
That is putting it mildly. Enphase didn't just report earnings, they seemingly resurrected the entire solar trade overnight. The stock ripped from around, $37 to over $51 in a single session.
A 38% move.
Exactly, and the volume exploded. 4 times the 50-day average. For months, the whole narrative has been solar is dead, interest rates killed it, Europe is over.
It was a very bearish consensus.
And then this call happens, but I have to ask right off the top, is this real? Or is this just a massive dead cat bounce fueled by people covering their shorts?
It's the question on everyone's mind. It was a massive sentiment shift, yes.
But is it fundamental?
Well, what's fascinating is that if you just look at the headline numbers without context, you might be confused. Revenue was actually down about 10% year over year.
Right, which sounds bad.
It does. But the market reaction tells you that this wasn't about where they've been. It was all about the declaration that the bottom is finally definitively in.
Okay, the bottom is in. I feel like we've heard that before in this sector.
We have.
Every quarter, someone says we've hit the trough and then the floor falls out again. What makes this time different? Let's unpack the actual numbers first. What did they put on the board that justified this kind of move?
So the headline results were a classic beat and raise in spirit, even if the raw growth numbers aren't exploding yet.
Not yet.
Revenue came in at $343.3 million. That beat the street's expectation of around $338 million.
So a small beat on the top line.
Nothing huge there.
Yeah.
But the real story was profitability. Non-GAAP earnings per share smashed forecasts 71 cents versus the 59 cents expected.
Okay, that is a significant beat on the bottom line. How did they squeeze that much profit out if revenue is down? Usually when your top line shrinks, your margins get crushed because of fixed costs.
That's the magic of this report. Despite significant headwinds from tariffs, which we absolutely need to talk about, their non-GAAP gross margin held strong at 46.1%.
Wow.
That shows you they have pricing power even in a downturn. But the magic words, the thing that really sent the algorithm scrambling to buy, came from the guidance.
The guidance.
Management explicitly framed Q1 2026 as the low point for demand.
Low point. That is the phrase that pays. But again, I'm skeptical. Are they just guessing?
Well, they're guiding for revenue between $270 and $300 million for Q1.
Which is low. It's a step down.
It is a step down. But they're forecasting improvement through the rest of 2026. Basically, they're saying, we have cleared the decks, the inventory's gone, and from here on out, we climb.
So the market looked at that forward guidance and just decided the bleeding has finally stopped.
That's the takeaway.
And they have the cash to survive this climb, right? This isn't a company running on fumes.
Far from it. They have a Fort Knox balance sheet. $1.51 billion in cash and liquidity.
Okay.
And here is a confidence signal that I loved. They have over $600 million in convertible debt coming due in March. In this interest rate environment, most companies would be scrambling to refinance.
Oh, for sure.
Enphase, they're just going to pay it off with cash.
Just writing a check for $600 million.
Exactly. No refinancing risk, no dilution for shareholders, just clearing the debt. It's a massive flex of financial health.
Okay, so the financials are solid, the balance sheet is a fortress, but let's dive into the operational stuff because that's where the turnaround story lives or dies. You mentioned the low point, but what is happening with the actual product? Is anyone actually buying microinverters?
This is where we look at the most critical metric, sell-through. For listeners who aren't glued to supply chain jargon, sell-in is what Enphase sells to distributors. Sell-through is what distributors actually sell to installers to put on roofs.
Sell-through is the real demand.
It's the real demand. And in the U.S., sell-through is up 21% sequentially.
21%. That's a massive jump for a sector that supposedly has no demand because of interest rates.
It is. And it pairs with the inventory story. For the last year, we've been hearing about the inventory correction, which is just a polite way of saying warehouses were stuffed to the ceiling with unsold inverters.
I remember.
Management stated clearly. U.S. channel inventory is now lean. Global inventory is normal. The destocking nightmare of 2024 and 2025 is effectively over.
Inventory talk is usually boring enough to put an insomniac to sleep, but in this case, lean inventory equals future revenue.
That's it.
If the shelves are empty, installers have to buy new units for every new job. They can't just draw down old stock anymore.
That's the mechanic. However, I do need to add a layer of nuance here, because I know you like to poke holes in the bull case.
I do.
There's something called safe harbor revenue. They booked about $20 million of it in Q4 and expect $35 million in Q1.
Safe harbor. Sounds like a tax loophole.
It essentially is. Installers are buying equipment early, specifically equipment with domestic content, to lock in tax credits before rules potentially change or deadlines pass.
Okay, hold on. If they're buying equipment just to lock in a tax credit and not because they have a customer waiting for it, isn't that just channel stuffing with a fancy name?
That's a fair question.
Aren't we just building up inventory again that will bite us in Q2?
That is the risk. However, management argues that $35 million is a drop in the bucket compared to the broader demand. And unlike the previous glut, which was just oversupply, this is inventory that is financially advantaged, meaning that inventory is more valuable to the installer because it carries a tax credit. So it's likely to move faster. But yes, it does muddy the water slightly. It's not pure end-user demand.
Fair enough. So the U.S. is waking up with some tax incentives greasing the wheels, but we have to talk about the elephant in the room, tariffs.
Reciprocal tariffs. That was a buzzword of the call.
Right. Enphase manufacturers globally, they took a huge hit, 5% to gross margins, or 510 basis points. That's painful. How are they maintaining 46% margins when they're losing 5% off the top to taxes?
It is painful. And tariffs are hitting everything. Microinverters, batteries, accessories, even moving manufacturing out of China doesn't fully solve it if the raw materials are still taxed.
So what's the plan?
Well, this is where Enphase is doing something incredibly clever.
Yeah.
They aren't just eating the cost, they're engineering their way out of it.
This brings us to the shiny new toy, the Gen 5 battery. We need to get technical here. Everyone launches a new battery. What makes this one different enough to save their margins?
It is the star of the show. The Gen 5 battery is targeting a 50% higher energy density, but critically, a 40% lower cost structure.
40% cheaper to make. How? Is it just cheaper labor?
No, it's physics and geometry. They're switching to prismatic cells.
Okay, explain that for us.
Okay, think about a standard battery pack like the one in a Tesla or an older Enphase unit. They often use cylindrical cells.
Picture thousands of AA batteries taped together.
Exactly. And cylinders are great, but they're round. When you pack round things together, you have gaps. That's wasted space.
Got it.
Prismatic cells are rectangular. They're like bricks. You can stack them perfectly with zero wasted space.
So it's like packing a suitcase with books instead of tennis balls.
That is a perfect analogy. You get 50% more energy in the same box. But the cost saving comes from assembly. With cylinders, you have thousands of connection points to weld. With prismatic, you have large tabs.
So it's just faster to build.
Faster to build, requires less cooling infrastructure, and uses less packaging material. That is how you cut your cost by 40%.
That makes a lot of sense. So in a tariff-heavy environment, the only way to maintain those high margins while keeping prices affordable is to just radically reduce your manufacturing costs.
Precisely. They can lower the price to the consumer to spur demand, pay the tariff, and still keep the profit margin high because the underlying box is so much cheaper to build.
And there's an AI angle on this battery too, right? Power match? Or is that just marketing fluff?
No, it's actually a really smart software feature. It reduces what they call tear loss.
Tear loss.
Every battery consumes a little bit of energy just to stay on, running its internal computer, its BMS, and so on. Power Match uses AI to look at the load and dynamically turn off specific microinverters inside the battery when they aren't needed.
So it puts parts of the battery to sleep when you aren't using them.
Right. Instead of idling the whole engine, it shuts down cylinders. They claim it improves efficiency by up to 40%. That's free energy for the homeowner just through better software code.
Smarter, denser, and cheaper. A solid defensive moat against the tariffs. But let's shift gears. They aren't just playing defense. They're finally going on offense in a market they've ignored for years.
The commercial market.
Yes. For as long as I've watched this ticker, Enphase was a residential story. Rooftops on suburban homes. Now they're talking about small commercial. Why now?
They're launching the IQ9 3P That's three-phase microinverter. This is a big deal technically. Commercial buildings run on 480 volts. You can't just plug a residential unit in there.
Right.
To do this efficiently, they built it on their gallium nitride, or GaN, architecture.
GaN is another one of those terms we hear a lot. Why does it matter here?
Well, traditional inverters use silicon. Silicon is great, but it has limits on how fast it can switch electricity and how much heat it generates. Gallium nitride is a wide bandgap semiconductor.
In English, please.
It means it can handle much higher voltages and switch much faster with way less heat. Because it runs cooler, you don't need big fans or heat sinks.
Which makes the unit smaller and lighter.
Exactly, which is crucial when you're asking a guy to carry 50 of them up a ladder to a warehouse roof.
So it's lighter, handles high voltage, and doesn't melt. Is this actually moving units, or is it just a prototype?
They already have a backlog of 50,000 units for Q1. Management pegs this as a $400 million total addressable market that they previously had zero share in.
0 to 400 million is a nice growth vector. It feels like they're finally playing in the big leagues.
And it provides diversification. If the residential homeowner pulls back because of interest rates, businesses might still be investing to offset their utility bills.
Speaking of pulling back, let's hop across the pond. Europe looked ugly in the report. Revenue tanked 29% sequentially. The narrative was Europe is dead. What is going on there?
It looks bad on the surface. The macro environment in the Netherlands and France is tough. But this is where management's agility really stood out to me.
Oh, so?
Since new solar sales are down, they are aggressively pivoting to the installed base for retrofits.
Retrofits, meaning selling batteries to people who already have panels.
Exactly. The catalyst is policy. Net metering is ending in the Netherlands, and feed-in tariffs are dropping in France. This means homeowners no longer get paid well for sending power back to the grid.
So the solar panels on their roof are suddenly less valuable unless
they keep that energy for themselves. This forces the economics toward self-consumption, which means batteries.
So they're going after their old customers.
Enphase is targeting the hundreds of thousands of homes that already have Enphase solar and selling them a battery to plug into the existing system.
And I love the tactic they're using. I read they're literally hosting homeowner events.
2 a week in the Netherlands?
It's like Tupperware parties for lithium-ion batteries. Come over for some cheese cubes and buy a 5 kilowatt battery pack.
It sounds funny, but it's effective. They're educating consumers directly because the market has changed. They aren't waiting for installers to do the sales pitch. They're doing it themselves.
It shows hustle. I like hustle. Okay, let's talk about the money side of things here in the U.S. We know interest rates crush the solar loan market. How are they fixing that?
Financial engineering. They're leaning hard into third-party ownership, or TPO, specifically prepaid leases.
Okay, walk us through the math on this, because lease usually implies you don't own the asset. Why would a homeowner do that?
It's all about the tax credit. Under the Inflation Reduction Act, businesses can monetize tax credits more efficiently than individuals.
Okay.
So here's the math. Let's say a system costs $30,000. High interest rates make a loan impossible. But a TPO provider, a company, buys the system. They take the 30% tax credit immediately. They might also get a depreciation benefit that a homeowner can't get.
So the company gets all the tax goodies.
Right. But in exchange, they offer the homeowner a prepaid lease. Basically, you pay up front, but the price is significantly lower, say $20,000 instead of $30,000.
So it mimics the economics of the old days when tax credits were easy and interest rates were zero. I pay less cash today, and I get the solar power for 20 years.
Precisely.
Yeah.
Management says this structure brings the effective cost for the homeowner down to levels we saw when that 30% tax credit was fully active and loans were cheap.
And is this live?
They have a pilot program active in 4 states with 40 installers right now. They expect this to replace the lost loan volume.
So they are fixing the demand issue with batteries, fixing the tariff issue with manufacturing efficiency, and fixing the interest rate issue with lease structures. It's a full court press.
It is a transition from being just a solar parts maker to a comprehensive home energy management platform.
Now, before we get to the trade idea, I have to ask about the buzzword that every company tries to sneak into their earnings call. AI. Did they say it?
They did, but in a very interesting context during the Q&A. They were asked about data centers.
Of course they were. Every stock is an AI stock if you squint hard enough.
But this one has legs. Management confirmed they are looking at 800-volt DC power conversion for AI racks.
Okay, pause. Why does a data center need a solar company?
Because of the physics of power. Data centers are power hogs. Currently, power comes in from the grid as AC, gets converted to DC for battery backup, back to AC for distribution, and then back to DC for the chip.
Every conversion wastes energy as heat.
Exactly. And heat is the enemy of data centers. Enphase's core IP, their secret sauce, is converting electricity with extreme efficiency. If they can supply an 800-volt DC power supply directly to the server rack, they eliminate multiple conversion steps.
Saving power, reducing heat.
And shrinking the cooling bill.
So this is the blue sky optionality.
Right. It's very early days. But if they can prove they have a solution for the data center power crunch, the multiple on this stock changes completely. It stops trading like a cyclic solar stock and starts trading like a tech infrastructure stock.
That is the sizzle. Okay, we have the stake, the turnaround, the battery, the cash, and we have the sizzle, the AI data center play. The stock is up 38%. What do we do with it now? Is it too late?
That brings us to the segment where we have to remind you.
Ah, yes, the big flashing lights.
The big flashing lights. This is not financial advice. We are just two voices in your headphones analyzing the data. Please do your own due diligence.
Right. But if you were a hedge fund analyst pitching to the investment committee today, what is the trade? Because just buying after a 40% rip feels like chasing.
I wouldn't just buy shares here, no. I call this trade the Silicon Sun straddle.
I'm listening. How do we structure this?
Here's the logic. We have confirmation that the bottom is in. Management said it, the market bought it. However, the Q1 numbers, the actual revenue, will still look low. 270 million is not a big number.
Right.
The real explosion in revenue is expected in Q3 and Q4 of 2026 when that Gen 5 battery and the IQ9 commercial inverter really ramp up.
So we have a timing gap. The stock is up on hype, but the numbers won't justify it for another 6 months.
Exactly. So the play is long leaves, long-term equity anticipation securities. You buy call options for January 2027.
So you're buying time.
They're buying time. You want to capture that back half ramp of the Gen 5 battery without getting shaken out by weekly volatility? You are betting on where the company will be in 18 months.
Okay, that's the bullish leg. But what if tariffs get worse? Or what if Q1 guidance is just a little soft?
That's why it's a straddle. You pair those long-term calls with a short-term put spread expiring around the next earnings call.
The hedge.
Yes, because the tariff situation is still fluid. If a headline comes out about new duties, or if that Q1 guide is just a hair soft, the stock could retest support. The put spread protects your downside in the short term while you hold the long-term calls for the big recovery thesis.
So if the stock drops 10% next month, your puts pay out, offsetting the temporary drop in your calls.
That's the idea.
And the wild kicker.
The wild kicker is that AI data center story. If they announce a partnership, even a small pilot, with a major data center operator for that 800-volt architecture, those 2027 calls could go nuclear. You're essentially getting a free option on their transition to a tech hardware multiple.
I like it. Defined risk, exposed to the upside, hedging the immediate volatility. The Silicon Sun straddle?
It's a way to play the recovery without betting the farm on a straight lineup.
So let's bring it home. What is the one big takeaway for the listener who is just tuning in?
Enphase just proved resilience. The sector is in a depression, tariffs are hostile, and rates are high. Yet they beat earnings, they protected their margins, and they have over $1 billion in cash. They proved that high-quality U.S. manufacturing and software can survive the storm.
So the only question left is?
The only question left is, do you trust the recovery ramp in the second half of 2026?
They called the bottom. Now they have to build the ladder back up. Keep your stop losses tight, watch that sell-through data, and your due diligence deep. This is Talk Tickers signing off.